Welcome everyone, thank you for joining me in this video today, and I thought we'd address how to improve performance. And I'm going to be looking at this from the perspective of being a investment professional working with clients, and some of the common questions that are raised by clients and discussion points when it comes to performance. So to do this justice, what I thought I'd do is look at how we are judging performance, then to think about why some stocks don't move, and also then to think about how the short term actually fools us into making rash decisions. When we judge performance, invariably, especially clients, what they'll do is they'll judge their performance against their peers. So they will have a family member or a friend who will describe about an investment which has gone up 10 times perhaps over the last 5 years, or of another investment which has gone up £10,000 in the last 6 months. And they will look at that and they will compare that against their own portfolio or their own investment, and sometimes they will want to copy and emulate that. But the investment rationale for that particular person might be completely different from you. And really, from the outset, you should be thinking about what your investment objective and rationale is. So this usually falls into 3 areas. The first area really is your monies. You want it to be invested and it provides you with an income. The dividends and the other interest provides you with an income, and the actual monies doesn't really fall in value at all. The next is having your savings grow in line with inflation. So the purchasing power of your portfolio or of your monies to be the same today as it might be 10 years from now. And then there are those clients who want to grow their portfolio so that they can have a pot of money to provide for a child's first home, or to have that huge house, that huge second house in the Caribbean. Whatever the aim, whatever the objective, it's to grow it for that particular rationale. So if you have those objectives in mind, then it doesn't really matter what's happening over the short term, and it shouldn't matter about what your friends are doing. You have your own measure for what you want to do with that investment, and that leads to much better decision making. Another area which people go wrong is getting out of an investment too soon, and that's because the stock hasn't moved, and some stocks just don't move and takes a long time before they do. Some people get itchy feet because of that, and that does impact performance. So I'm going to think about the reasons why some stocks don't move. So some stocks just haven't really, or just not really attractive. So investing, and especially the stock market, is like a beauty pageant. Some stocks are just far more attractive than others. And so that attraction will lead to people investing in it. So if you take Tesla, people are driven by the story around Tesla. You have a very charismatic CEO, and you have a car manufacturer which is seen as contributing to a net zero carbon emissions world with electric battery powered vehicles. And you then also have, and you're buying into the story about the fact that this is fast growing company. And you compare that with another car manufacturer like Ford, which is a company which has been around for a very long time, over 100 years, and has gone past its growth phase in a way which is completely different from Ford. And it's seen as humdrum, it's seen as the car manufacturer of yesterday. It's seen as a company which is contributing towards carbon emissions in the world. And so with these two car companies, you can see why one would be moving in terms of its stock price and one might not be, because the story for one is far more compelling than the other. Another reason why stocks might not move is because of its size. So companies which are large will be on the main exchanges. So in the UK, that would be the FTSE 100 or the FTSE 250. Now, the buyers of those stocks would be sometimes you and me as retail investors, but also they are the large institutions. And some institutions, like ETFs, are forced buyers of stocks, even if there are profit warnings for that particular company. Because what an ETF does is it replicates a particular index. So it is in effect a forced buyer sometimes of some stocks. So that could be the reason why as well that your stock might not be moving. Another is just the fact that some companies take a long time for the idea to really capture everyone's imagination. Even if I think about Bitcoin, in the first 5 years of its creation, no one really understood it, but you fast forward to where we are today and you've seen the rapid growth of this asset and the number of people who are talking about it. So sometimes it just takes some time. And you, as an investor, where you see the particular growth happen is by being patient, is by believing in the idea, the stock that you're buying into, and waiting for everybody else to catch up. So let's talk about the short term and how that impacts people's decision making. So investing is very thrilling and also emotionally charged. So you could be doing some research on a company and that company has shown some really strong returns. But you're fooled because you only see those numbers and you don't want to miss out on any further growth that might be forecast in the future. And so you might rush into a decision rather than stepping back and actually thinking, what are the other factors behind that investment? What is the issues behind the board of directors? What is the outlook in terms of the environment for that company? You need to be having a much more thorough analysis, so therefore you improve the long-term decisions. And another reason why the short-term fools people is the differences between trading and investing. When someone's trading, what they should be doing is they have a price target of a particular asset in their mind, and once it reaches that price target, then they should be selling out. But what invariably happens is that they confuse that discipline of trading with investing, because once that price target hits, they get greedy and they hold, and then they continue to hold, and then lo and behold, the market turns. So you need to have a disciplined approach if you are going to be a trader, rather than being an investor where you are much more measured and balanced. You're prepared to take short-term falls in value because you know that you've done the analysis and that this is a company which is going to do well in the future. What does this all mean for you? So the first thing you need to do is stop comparing yourself against peers. You should have your own bespoke mandates and rationale for investing. The second is to stop thinking about the short term, because there are big drivers that are happening in markets over the next 5 to 10 years, and that will deliver some strong returns. It might not deliver you strong returns today, but you should have a long-term out mindset. The third is to absolutely think about fees and where that plays a part in the return. So you should be thinking about the online platform you're on. You should be thinking about the commissions that has been charged and the custody fees as well for holding investments and other administration fees. Do a yearly review, compare and contrast. The next is to communicate. That's the reason why we have this video. It's to talk about where you're going right, where you're going wrong, and take tips wherever they may be, no matter how experienced you are. And the next and last one I would really sort of leave with before I end is to really just build up an ideas log. It's to spend, let's say, 15 minutes a day reading about what are the main drivers of markets, reading about companies, and building a list of really interesting ideas that you can invest in or you might think about investing in, so that when you do sell, you're doing it for the right reasons. You're doing it because there is a really compelling idea that really you want to be invested in. So I'm going to leave it there. I hope you liked. And I'm going to leave you with one question, which is, what is the difference between investing for the long term and investing for the short term? And how do you think as an investor?